Hey, morning, fellow traders. Today, big day. We're looking at Amazon announcing earnings after the bell. And I've done a lot of work on this one, and I'm really excited about it. And here's what I'm looking at right now. Right now, I'm looking at a little bit of a different screen than you're used to seeing, where I superimpose the stochastics on the main screen to kind of show the ebbs and flows and overbought, oversold to see how they're correlating. And what I'm seeing is Amazon is up at high of 337, currently trading in the low 330s, 331, and I think we're going to kind of finish up in this range right here. We are in the overbought situation, which is nothing new for Amazon, and earnings is today. MACD is positive. Want to take you back to a page that I also look at, and this here shows the straddle and strangle performance of Amazon over time. So what we're looking at, here's the symbol of Amazon, and we're showing it, and here's what I'm going to have you take a look at. What we're going to look at actually up here shows the difference in the straddle cost as we get closer and closer to expiration. Now, this is the subject of a different type of talk, but basically you will notice that the straddle price doesn't move because theta decay is being negated by the increase in implied volatility. And that is very conducive to being around earnings. So we shouldn't be selling premium running up into earnings because the volatility or the vega is going to make up for the straddle decay or the price decay, the premium decay. So you will not see much of a variance. Once earnings is announced, everything will crush and revert and everything will happen all at once. But here's the thing that I look at. I'm taking a look at 3, 6, I'm looking at the past 10 earnings dates on Amazon, and we can see pre-earnings. What it does is it gives you the straddle, and it shows you the implied move based on the market maker move of the straddle. So for example, the last one, July 25th, the price of the underlying was 303. The straddle cost was 22.80, which gave an implied move of 7.047%. And the opening price, the price opened up at 299.55, which represented a gap down of only 1.26%. The straddle cost dropped with the volatility crush to 14.75, and the return was minus 35.3%. And it was 312. Now, by the end of the day, it was actually even worse. It was about the same. But my point is that I am not a premium buyer looking to buy straddles, but if I look at the other side of the trade, selling straddles or selling strangles or doing a short premium trade, this is basically telling me that the underlying has moved within the implied move. And if we take a look at it, we could concur that every one of these negative returns based on straddle buying, with the exception of this one, showed a profit. So a negative on a straddle, on a long straddle, would be a profit on a short straddle. Conversely, we could convert that to a short strangle if we don't want that type of risk. But for example, on a short strangle, we would be collecting $2,280 and paying back $1,475, pocketing $700 or $800. But if that's too risk for your tolerance, or if your margin account doesn't allow that based on your brokerage and your bank balances, you could simply look at iron condors, which are outside of the implied or inspected move. And you would see that based on the last 9, 8 of 9 were winners. And that's a pretty good thing. So it's kind of telling us that implied volatility, which is a guesstimate of an implied move, has been a little bit understated over the past several times. And what we're doing is really just looking for edges. Of course, we have no idea what's going to happen tonight or tomorrow, just look at Netflix. But the kind of things we look for is really based on looking at the past. So to make future decisions. So what does that tell us? If I go now and take a look at the Analyze tab, I am going to look at Amazon, and we have a 1-day expiration. And I'm looking to see if there's anything interesting that jumps out at me. First off, one of the things I look at is the IV percentile, which basically you can see is at 64%. It's got to be over 50%. So that being said, I'm looking out at the 10 deltas. So if I take a 10 delta, I'm looking at a 157, a $1.57. And if I go out to about a 12 delta on the call side, we're looking at about a $1.63. So if you add the two together, we're looking about, if I put an iron condor, if we were just to do this as a short strangle, you could add these two and you would be collecting about $3 and something cents. But if we want to be a little bit more conservative, we could look at a 10 wide iron condor. Now on a 10 wide iron condor, I have chosen the 295. Actually, I've looked at the 15 wide iron condor, and I've looked at the 295 280, which collects a credit, and also the 365 380. So basically 365 380, 295 280 gives us a credit of $2.05. So that $2.05 is based on a risk of $1,500 per contract minus 2.05. So we're looking at a $1,295 downside potential. However, again, there's always adjustments and we could always roll it, and there's a lot of different things we could do, but this is a high probability iron condor because we are looking at 90% deltas. Now, does it know that earnings is being announced tomorrow? Well, maybe, maybe not. It does know that the implied volatility is very high, but the probability out of the money is still 88.19%. So the odds are overwhelmingly in our favor. And for $2, this is a trade that I am probably going to commit, and I am going to be looking to put it on. I'll go to the afternoon and see how price movement is taking it. When I look to the charts, I'm going to go to one of my different views, my rainbow view, which gives me a little bit more clarity, and we could see we're oversold and moving up on the stochastics. On the longer term, we're a little bit overbought, but we can see that we have been basically kind of in this 320 to 337 range. We're in a 17-point range here, and we've got an implied move of 22 points. So I see a lot of things positive in Amazon, and I really like the fact that only one time in the last 9 or 10 earnings announcements that we've exceeded the implied move. So I think we got a lot of things on our side. The risk reward is conducive to a 90% out of the money, and this is my trade. So we'll follow it. We'll see how we do tomorrow, and hope this helps. Thanks. Bye bye.